Welcome to the ninth episode of Journey to $10,000 a month from trading. This episode might be the most important one in terms of my strategy and how I look at the market. We are going to talk about market open. Market open happens at 9:30 a.m. EST standard time, which is basically the New York time. And what do we want to look for when the market opens? We want to see a manipulation to one of the sides, taking out the resting pending orders, and then to price to revert back into that original direction. This is like the 101 of my trading strategy, which I'm gonna talk and basically define it as a whole in future videos. But this is the first step of my strategy. Yeah, like really pay attention to manipulation during the market open. Yeah, and also besides that, we're gonna talk about 9:30 or like that 1 minute candle of or market opening, the high and the low of that candle, and the first FEG that get formed after the market has opened. These are very high probable confluences to get swept. Yeah, like we are not gonna left unswept like the first fair value gap that gets formed after the market has opened. So let's get into some market opens and see how a price is reacting. First example, this is the 9:30 candle, the market open candle, and what do we see? Massive top wick, which taken out this buy side liquidity, which was the manipulation into the opposite side, because we were in a bearish trend and we wanted to continue pushing down. And what did the market do? Opened, price rallied to the upside, taking out this buy side liquidity, maybe forming S&T on the highs, I don't know, that's besides the point, but taking out the buy side liquidity and then changing the structure back to the downside. Yeah, we have this inversion. We could have taken a short setup from that, stop loss at high and take profit maybe at some external sell side liquidity. Yeah, whatever. But the main point is that we have the market open and that manipulation happened at the market open. We could also mark out the first fair value gap that got formed after the market is opened. Yeah, so like this was the candle, and this was the first fair value gap that got created. You can see that we retapped the fair value gap and continued selling downwards from that we respected that first fair value gap that got formed. We could use it as an entry confluence, like that first fair value gap that is formed. Another example, yeah, this is the 9:30 market open candle. What do we see again? We are in a downtrend, in a bearish trend. Market open, take out this buy side liquidity, these resting orders, and sold off back to the downside. Yeah, what do we see? Maybe some change in state of delivery happening here. Yeah, we can mark this up. Take a sell position from here when it happened. Stop loss at a recent high. Maybe you wanna be more risky. We could set it tighter stop loss at the candle body high and take profit maybe at this external opposite sell side liquidity. But what is important, that manipulation into the opposite side of the trend when the market is opened. Yeah, and that happened here. Another very choppy example. This is the market opening candle. You can see that the price has opened, it pushed up, but not sweeping that 9:30 low, yeah, leaving it untapped. When we are not sweeping that 9:30 low, that usually means that the manipulation is still happening. Yeah, like we went up, swept this buy side liquidity, and then we maybe reverted back down, sweeping that 9:30 low. And you can see that we haven't broke down below that. We actually swept it, respected it, and went back to the upside. And this is a really choppy example. Yeah, really choppy example. And you don't usually want to trade days like this when it is very bi-directional. Yeah, like sweeping the high, re-sweeping the low, re-sweeping the high, and then selling back down. Like, what is this? Would really take you out on both longs and both shorts. Yeah, so whenever you have like no manipulation down, went up, swept. This was the original manipulation that I would personally accept as manipulation and went back down, but respected the 930 low, you have a very low probable day and very high probability of not being a good day. Yeah, like very rangy price action. I just wanted to show you bad example of when to not look for a trade, even though the market manipulation actually happened. Another wonderful example. This is the market open candle. What do we see? The price dumped below, leaving that 9:30 a.m. Opening candle high untapped. Yeah. What do we see? Price taking out the sell-side liquidity. Yeah, this was the manipulation like this down. Maybe here could have been some S&T, I don't know. But then what do we look for? An inversion happening. Change in state also happened. New fair value gaps got formed. Yeah, right about here. We could take longs from these. Stop loss at the low and take profit. I mean, this would be very high probable, but very bad risk reward. Yeah, like 0.7. Yeah, like what is this? So I would personally target maybe like here the external buy side and put my stop loss at break even when it tapped this 9:30 a.m. high. Because what could happen? Also, like in the previous example, it could be rangy price action. Yeah, because again, opened, went down, went up, tapped that, swept that 9:30 high, and it could easily rebalance back down. So I would put my stop loss to break even after this high gets swept, and yeah, the take profit stay the same. Yeah, but if we zoom out, you can see that we were really oversold to the downside. And in the grand scheme of things, we wanted to rebalance back up from the high to the low. Yeah, this was like the fair value, and we actually rallied through that. But this was that example. One last example. This is the 9:30 candle. Yeah. What do we see? What is different from the previous examples? The 9:30 low got actually swept right away. That's the very important thing that happened. Yeah, so like this was the manipulation. Then it went up, rebalanced back to the change in state. Yeah. Maybe faked out some traders on this change in state happening again, but that's beside the point. I would not take a setup from here. Yeah, like because this fair FEG got inversed. But after that, what do we see? We see price not tapping this low because the 9:30 low got actually swept before. Yeah, so price reverted back up, made some fair value gaps, some bullish fair value gaps from that. Actually formed a change state of delivery right at the same level, so we could take a buy position, stop loss at a maybe tighter stop loss, maybe more conservative stop loss, and take profit at a recent buy sell liquidity. Yeah, I think this was the data high of that. I have not yet talked about data highs. Data highs and data lows would be just like a sneak peek. Data highs and data low are very high probability confluence. I'm gonna make a video. Next episode will be about that, but that's beside the point. You can see little spoiler alert. It swapped that perfectly. But yeah, this was the example of the market open. What was different again? The 9:30 a.m. low got swept right away, and that's why it did not reswap it. Yeah, like just rebalance back to this area, and we went back higher. That's pretty much it. Same as with anything else, you need to go on with yourself and scroll back through the time frame and see that market open happening, and ideally look at it happening live. Do not backtest. Yeah, like maybe you could backtest, but just see it happen live. Do not like scroll back, but maybe hop into some Forex replay and just backtest manually when you see the price happening live, when the candles are forming. You could also just wait for the market open, maybe the next day, maybe tomorrow, and look at the price happening, the market manipulation happening at the market open. Yeah, and that's pretty much it. Just you need to gather that market experience. See you in the next one. Peace. Data highs and data lows. Stay tuned.